Alright, so now that we've set it, the ground rules for the strategy, how it's meant to be used, we're going to get into details how actually this thing works, what are the two indicators we've been talking about in a greater detail, of course. So we're going to start in here with framework, which is, like we said, the major goal in here is to answer simple questions. Is to figure out what kind of markets are we trading, because if you think a strategy is just something you apply in any context, and if you just think a trend is a range and everything like that, and you can just have simple buying and selling signals, then it is absolutely more complex than this. And the first actual question that obviously every professional knows and do naturally, either following the steps I'm going to describe in here or following their own steps, it's still the process. The mind process is the same for every professional traders. First of all, we try to put the market into little boxes. There are different boxes we can call context. That's how I'm going to name them in my own way of explaining the strategy. So we're going to answer this simple question: what is the current context and what maturity is associated with it? So it's three big boxes. We're going to assess the range, neutral range. We're going to assess the trend and something in between, which is called the trending range. So these are the three major boxes that we're going to try answering. Which one are we currently into? And obviously, it might be a subjective analysis, which means professionals have been seeing so much price history through years that they basically answer this question like naturally. I see a market, I know what it is. Is this a bullish range, bearish range? Is this just a flat range? Is this a trend? And what kind of maturity, what steps of maturity are currently into? I can naturally answer those questions in less than a few seconds. So the thing is that it is absolutely different when it comes to beginners, because beginners in trading having quite some troubles identifying those contexts and answering that simple questions. What context and what maturity? So I tried, as I figured out this problem among the people I was trying to get ahead of trading safely without taking too much risk, and I figured out the major problem they were facing is this: what the goddamn context is, and how can I help building a tool that will assist answering this question with a decent risk management? Because once again, this is about trading. So the indicator won't just give you a simple answer telling you we're ranging or we're trending and we're maturing in the trend or we're maturing in the range. The indicator will give you information, you'll have to process them, which means you're going to have to learn a few rules to identify clearly which kind of context you are. And it needs to be non-subjective analysis. It must not be disputable. It must be clear and simple. So we're going to try answering this first question. What do we use with Pro Framework to identify a context? And then we'll answer the second question, what maturity it is. So the thing is that what we're going to use in here is, we don't take care of the bottom line in here, which is momentum. We're going to talk about this one in a separate video right below on this website. So let's just zoom in on the chart so you have full space dedicated to what we mean. So these are all the parts we have into framework. So I've been highlighting the actual trading signals, the one that trigger an actual action through your trading account. But obviously, as you can see, there's multiple signals that needs to be ignored because they don't fit the plan of an actual context. So what we're going to use in here is the context channel, because it's been named for this specific purpose. It's helping to identify what context are you trading right now. Is this a range? Is this a trend? And obviously, it's going to be easy to understand those things. So what we're going to do is that we're going to switch to a blank chart to have a full analysis without those stuff right in here. Alright, so here's the same chart, it's just without the annotation, so we'll be easily being able to forecast what the hell is going on in here. So we're taking the SPX, as obviously it is a broad-based index, the most well-known stuff regarding market trading, so we're going to use this one in here as an example. So the first thing first is that this indicator has been designed for two things. For professional, to make sure that the indicator, which is absolutely not biased, the indicator is not meant to be bullish or bearish, it's just here to figure out patterns and represent prices in a different manner. So if you see a context and if indicators are showing the same direction in terms of risk management, then normally you should have low risk trades. So for professionals, like we said, it's going to comfort you into a decision-making process, making sure that you are out of any fucking biases, because it can be a problem for traders used to trade. At some point things can change within your life or anything like that, and you can have some short-term biases that may impact your trading. So in here you're going to have something watching over your shoulder, making sure that if you do any way different than your usual trading scenarios, then normally this should be like a safety belt telling you, no, you might be wrong in here, it doesn't work like that, or you shouldn't be trading in this area. Because this indicator, like we said, is not just going to take care of this. It's going to tell you what prices area actually matter. And in here, we're just going to take care of context first. So how do you identify the context? Purely and simply by just a few sets of rules. What you can do in here, and I suggest you do this mostly if you're a beginner, to just avoid a dangerous thing, which is when you're beginning, let's say we got less than 2 years of trading, normally you still haven't seen enough prices to see through noise, which means it's like you and I are looking at the same world, but I have Googles and you don't, and you see something which is really for you hard to see, and you might want to use goggles as well, but those goggles might need some time to process until you manage to see through them. So this is exactly it. So which means to me, I can clearly see throughout the noise of the candles and things like that, but beginners are having quite hard times doing it. So I suggest one thing for beginners: when it is about identifying the context, what you want to do is just deleting prices. There's a simple way to do it in TradingView. And you can do it using the specific thing I'm sharing with you guys, right? It's a specific template that I give you access to. You can copy it, and normally you should have these two things. Or you can use this. You simply get to the candlesticks. No, sorry, I need the candlesticks, all right? And what you do in here is that you basically switch to hollow candles, and you just put them fully transparent. So the prices are still there, but you can't see them anymore. And you can switch between those two types of candles. See it and not see it, because you're using hollow candles as absolutely transparent. But this way, you're going to have a much clearer sight of what really is happening in the market, because all the noise that the beginners will try to focus their efforts into, which is a waste of time, then you're just going to erase that noise and have access to all the reliable trading information to actually answer that simple question: what currently context are we trading into? We can go and play this game back in time. As you can see, any freaking time gives different context, because what happened back then doesn't mean it's happening right now. But still, the question is simple: are we trending or are we ranging? Definitely in here we can see that we're trending. All right, for multiple reasons, the context channels are definitely rising, and then you'll have additional informations, because answering trend or range, some people will say it's easy, but it's going to be complicated for some people. But in here you can clearly say it's trending, because you can see this. So now the second question: how mature is this trend? On a trend, you're going to have three major steps. You're going to have the accumulation, which is the preceding movements that pre-build the actual trading breakout, which is the second step. After the breakout, normally the market is fully trending, which means one of the two traders' counterpart has been leaving the battlefield. Either the bulls or the bears have been surrendering, and only bulls or only bears are trading for a different for a short period of time, which generally leads price to divergence, which is the step 3, and then you have a pullback, which is loaded up with new bulls or bears, and definitely you've got the final excess step, which is another breakout attempt that will generally fail and cause a range to build up. Range or consolidation, these are the same word, which means you're going to just retrace down the previous upward moves, bite by bite, until the major trends just reactivate itself. It's somehow following something close to the Elliott wave theory, the wave 1, 2, 3, 4, 5 structures, which is obviously just a theory. It's still the same old stuff that everybody plays with, but putting different names on it. Elliott wave is calling this impulse waves, and corrective waves, I'm calling this accumulation, breakout, divergence, pullback, and final excess. But it's still the same thing. It can be assimilated to wave 1, 2, 3, 4, 5 in Elliott wave theories. All right, still different terminology, but still the thing we use in the end is the same, and every professional uses that. We know how to trade breakouts because we may call this differently, but we all use the same stuff. So these are trends, and how to highlight this, pretty simple, all right? An accumulation in a trend follows a simple rule. The market is going to touch the context, pull back to the trend channel, shows a bullish signal, failing to retrace back to the support context, right? So getting resistant context on a bullish accumulation, we go context, we go back to trend channel, the market will buy this instead of getting to context, which means some trending sentiment starts to emerge. Then we go back to context, and normally having this we can create the breakout. But the breakout needs a very, very important information. We should see prices accelerating through both the context channel and the trend channel. So in here it doesn't fit the rule, which means in here is no bullish breakout, kind of a bullish breakout trap. That doesn't mean the trend wasn't bullish, just meant we needed one more pullback to the trend channel before actually breaking up. In here is where the actual breakup occurs following the strategy's rules. We've been accumulating, all right? We've been building the momentum, accumulating 2 times because we've done a sub-wave in here, all right? But still, the thing is that now we're ready for the breakout, and now you see prices breaking through the context channel and the trend channel in the same time. Both are accelerating, and there you know the breakout is setting in place. You know the trend is on the move. You know there is no point selling in there until you get to the actual price divergence, which is when the momentum starts to diverge from prices. When we build new highs, but not in the momentum indicator, and normally you should see those kinds of things, which is our breakout. We're going to talk about that later. So if you zoom it in here, you could have started selling in here, but the thing is, it was hardly divergent at this stage, so we just pushed the divergence right after. So this is the area where you would have started highlighting the trend divergence. All right, so let's put out the price out of the game so you'll have a clearer sight of what the hell's happening in a trend. The trend is breaking up. We're reaching out the divergent point, which means normally in here the next step is the pullback. A pullback is some sideways range that can go retracing deeply or not, but normally we're generally targeting Fibonacci retracement, and you're normally selling to buy those Fibonacci. Normally the prices will pull back to the trend support context, and normally afterwards you get the final excess, and then the trend terminates, setting a range or a consolidation, but normally this is where the trend stops. So in here in the US we've got something a little bit more special, but still the indicators were showing this right back in time. The thing is that you always look at how the context boxes in here will react. And in a trend, you're always going to have a look at the support context. Normally the pullback pulls back to those areas, but at some point you're going to have something different. It's the fourth option in the context, which is excessive market. When the market is excessive, you'll see the context boxes unfolding each other. The support context will start unfolding. The boxes are not folding one to each other. They're just starting to break in here. When you see this, it's a sign of a very late stage trend, which means in here you're looking at selling only, not buying. It's not possible to buy. Selling entries only. But the problem is, in here we went to an even more dangerous context, which is the market excess. Not the final excess of a trend, just an excessive market, when both support context and resistant context are having gaps. When you have this, huge problems ahead. Means the market is acting irrational, either for a good reason or a bad reason, but it's acting irrational, which means the strategy cannot be applied. It means you are in an excessive trading scenario that needs to be assessed by some external figured informations. So in here it was the tax plan who's been causing that shit, and we knew how it ended. The market went irrationally bullish and it obviously collapsed right after. So it was a problem, erratic price action, dangerous behaviors. Every beginner should get the hell out of this. When you see this, if you were selling, you stop loss and you stop trading this asset. It's acting irrational, and it can be just a tiny little excess, some irrational pricings, but it can also be a bubble. And when it is a bubble, if you're holding selling trades in this, oh man, you're gonna end up really fucking ruined. So be aware that the strategy has its own flows, because nothing is perfect. And obviously when the market is excessively trading, when you're a speculator, you're gonna have troubles. So the strategy is also meant to detect its own irregularities in which you must absolutely not trade. So when you see boxes unfolded, either you try a final trade, which is what we call the final excess. You had a price. So in here, you knew this price. I don't even know. We're going to see what price is. I'm doing this analysis without the prices. So you can see that there's no bias of reading the prices. In here, there was an interesting price. We'll see how it's been reacting. We've been breaking through this. So it was the last time you could have tried selling. And in here, the market decided not to do it and accelerate. So this is the moment we just lift off and decided the bearishness no longer possible. It's the new paradigm. It's the tax plan is going to revolutionize everything. Obviously, afterwards, we knew it wasn't about that. We just have been extended stupidly that bullish trend, which means regarding what we've said earlier, all right, we had the trend pullback, the trend divergence in here. We should have had a pullback and a final excess. What we've done is that we just skipped this, faked the pullback, going crazy irrationally bullish, made the pullback in here, made the final excess there. But that means what? The US trend is over. Yes, it is. And so far, we have absolutely no clue that this thing is about to end and to go any further away. We didn't even nearly consolidate so far. We just started consolidation. So what we're currently trading right now in the US is simple. It's a range. So we don't know what this range will look like. It could be looking like a flat range. We just flat consolidating here before eventually restoring new bullish trends or start a deeper consolidation structure. I think both are possible, but just right now, the context is a range. So those who think there is a bullish trend right now at Wall Street just are probably wrong because everything in here suggests it is absolutely not the case. So the point in here is this is how you're going to answer what actual context are you trading right now. So you just see what is happening in here. How does a range plays its game? That's it. The boxes are folded, heavily folded one to each other, suggesting indecision, and the price will generally oscillate between those boundaries. Anytime it will try to break, it will fail, and that's a sign of range. So you can clearly see back in time, there you have a range, there you have a range, there you have a trend. Obviously, same thing goes in here. There you have a trend, and there you had a range. All right? All of this is about time frames because any time frames we're going to show you different context, channels, and things like that. So, oh my God, what have I done? All right, we just switched to another asset. Sorry. All right, so let's get back to this. If I manage to do my stuff properly and avoid doing some shit. All right. So here we are, all right? So now we just switch to the higher time frame because you really need to understand something about this framework indicator. It's just like multi-layer time frame analysis. Each time frame has a different story, and you're going to pick up the time frame that suits your needs. You want to sell, find a time frame that shows potential selling entries, and don't try time frames that doesn't corroborate your scenario. Like if you have a bullish bias right now at Wall Street, just trying to figure out a timing and actual time frame that shows the potential bullishness opportunities. As right now, weekly chart suggests bearish opportunities, daily chart was suggesting the same thing. If you want to buy, you know that you must not buy out of weekly signals or daily signals. So the thing is that this framework indicator is going to tell you what time frame to trade on regarding what you want to do. If you want to buy, if you want to sell, for God knows what reason, then you'll know what time frame it is related to. If you want to buy out of a weekly context, which means something you want to buy and hold for 12 to 50 weeks, so your kind of trade, 1 year long kind of trades, then you know this is where you want to buy. It's at least 2,400 and probably even lower than that. If you want to sell, you can do it right now. Obviously, it requires signal, the thing we're going to talk about later on, right into the momentum indicator. But there are other parts on this one that we really need to talk about. We're already 20 minutes in, so I'm going to move on. Let's restore the previous the previous chart. So we talked about the context channel and the different steps of a trend. But this indicator will provide other stuff. All right, you're going to have some targets in here, which are breakout targets. We're going to talk about this. We're also going to describe those little arrows, blue arrows and red arrows, saying what this is about. There is also Fibonacci support. Like we said, we're going to use Fibonacci in this strategy. So there's an automatic Fibonacci display. In here in the screenshot, you might barely see it because it's a 4K screen, and therefore the lines are pretty narrow. So let me just put them a little bit more thicker so you'll see how it goes. All right, these are the Fibonacci's, automatic Fibonacci. They'll put themselves and adjust to the current context. So as you can see in here, you got 23.6, 38.2. All right, these are areas you would trade in the range, different ranges, boundaries. All right, so automatic Fibonacci retracement, sine wave breakout target. I'm going to explain in detail what this is about. Context channel, trend channel, only available and only usable for trend context. The trend channel in a range context, it doesn't even matter. All right, it's just when we're trending, normally the trend channel should see some price reaction. All right, so back to the previous thing. All right, so this is how it is. All right. I'm going to talk about this, what this is, what it represents, and how you can use those informations. These are coming from sine wave. Remember what we said earlier, sine wave is taking care of cyclical analysis. It studies how cyclical behaviors behave with prices. And there's going to be some convergence and divergence, which means at some point, this is predictive analysis. It's going to predict that at this moment, bears should be holding prices, and then this is bulls times. It's oscillating between bulls moments and bears moments. And obviously, at some point, this analysis will just be as right as it is, which means bulls will show up when they're expected to show up, bears will show up when they're expected to show up. But at some point, there will be divergence. The indicator will say, now we should have some bears, but they don't show up. So there's going to be divergence between what the indicators expect and what the prices actually show up. These are things that we call breakouts, when we break through cycles. This is a technical information, just like the momentum divergence, and we can take advantage of them. That's what we're going to do in this indicator. It's going to highlight prices area. This is a smart algorithm. I don't have really the time to get into details, but obviously on the daily videos and things like that, I'm giving you all those tips, what those things represent, how we're working those algorithms. But in here, I just want to stick to the essentials. So those breakouts are this: divergence between expected price cyclical activity and actual price activity. All right, and you're going to have different types of breakouts. As you can see, you're going to have little crosses, you're going to have boxes in here, square boxes, and you're going to have diamond signals. So it is 3 types of breakouts already detected by the algorithm, so the algorithm don't filter them. The cross signal needs you to, requires you to do a second analysis. You need to filter out, because there's going to be 2 types of breakouts. Range breakout, which are basically normal breakouts happening in range, the change in mood, change in path, rapid changes that doesn't mean anything but just noise in the surrounding area, generally suggesting a range is going to build. So you're going to switch to short-term range activity. Or breakout, trend breakout. So as you can see in here, remember what we said. This is where we've been breaking up. This is where we've been trending ignition. Oh, sorry, we were daily chart back then. As you can see, it's going to be the same old stuff. So we're going to go back to the daily charts. Just wait for the indicators to show up. All right. So as you can see, that's what we said. All right. Back in here, back in the game, we were, all right, zooming out. We just had the breakout in here, the trend breakout. The moment we broke through context and trend channel. You're going to have additional information, because in here you obviously want to see those kind of breakouts. You want to see this. You want to see a change in the mood, a radical change. The bulls are taking over, so they should be breaking the bears' timings. And that's what confirms you definitely have a breakout in here, and you know it is about to trend trade in here, and you should absolutely not try to fight that at this moment. All right? These indicators will be here to tell you whenever you need to fight the consensus or just go along the way. When the trend is in place, don't try to fight it. It's absolutely worthless and pointless. On the opposite end, when you're late stage trending, even if the consensus is firmly bullish, you'll know it is about time to lock on the gains and reverse. But obviously, no one will tell you. If you listen to the consensus right now, it's bullish, it's firmly bullish, so you can be fully biased at the moment, even though normally in here the indicators suggest a range is at the game. So you shouldn't be bullish, you shouldn't be fully bearish either. It's just you should be hesitating right now, selling high, buying low, and don't go more complicated than that. Anyway, so now let's talk about the squares. All right, so these, like I said, can be trend breakout or range breakout. It will depend on how the context behaves at the moment. When you're divergence trading, it is probably setting a range. So it gives you price area to forecast the potential divergence to put in place. Just like in here, we were late stage trending, all those targets were highlighting areas where you could have speculated bearishly against the consensus, counter trend trades. All right. in here definitely confirms the bullish breakout and the trend attempt, so obviously those targets will be overcome and the price will rapidly and fastly break through them. Alright, now let's talk about the square. Square ones are definitely ranging, so when you see a square, means the market is definitely not trending. It's ranging or it's consolidating in a trend. Which means at this moment, as you can see, those squares, they were signaling that there was no breakout. There was no trend breakout. It wasn't confirming any such thing at the moment. It was just saying we're ranging. So don't be overconfident. The trend breakout may come later on, but so far we're accumulating. So don't be too much bullish. Just be bullish because we might be accumulating, we might have early signs of an upcoming trend, but the trend is not yet coming over. And I so remember, oh goddamn, so many traders were trapped in here thinking that yes, we're about to rise forever. That just got wrong-footed for a bit after being proven wrong, being proven right. So back then, if you knew this was just ranging, you would probably have acted differently and you would have been way more profitable than those who were thinking that this is just a one battle, we're going to go straight forward, straight line. Those who were too bullish in here just got wrong first. They got proven wrong and then right. But you want to try avoiding this as much as possible. All right? So those things are higher level, higher degree of certainty. That doesn't mean there is any certainty. We never know. We just limit the risk. So this means the algorithm doesn't really know what this is. Is this range or is this trend breakout? We don't know. So you have to review this using other reliable information. So this is not subjective analysis. If you do have a breakout context, you should really be able to see it through the context channel and trend channel. Otherwise, it's probably just a range breakout. Those ones, high level of certainty from the indicators suggesting a range activity is at play. So as you can see right now, what do you see? It's definitely confirming the range context. Any fucking way. You can put it any way you want. It is a range right now at play in the US, definitely not a bullish trend. All we can have right now is another excessive market. But still, before we actually lift off, we're damn far from it. Look at the boxes. They're firmly folding each other. So definitely a range context right now. Whether you like it or not, that's what it is. Anyway, so those, and finally, where is this? We had it earlier, so let's go back to the weekly charts and you'll see one. All right, the diamonds. The diamonds are a third and final analysis that gives you odd for a range to be bullish or bearish. When this thing shows up, means the range we'll have in here, range and signal with the diamond, suggests the range is probably bearishly oriented. Remember what we said earlier regarding the three different contexts. You had range, neutral range, you had trending ranges, and trends. So this is a sign of an upcoming trending range, which means this range, once it will be built up, has high probability of being broken by the downside. But as you can see, this is not a perfect indicator because it gave you this signal back then, all right? The thing is that, was this a range? All right? You always need to put things in context. In order to use this signal, you need to have a range. So if we do build a range right now in the US, we know that the odds in a weekly charts are probably to break down this range. And we're probably going to set ourselves back to the previous range we had in 2016. All right? So those who are long-term traders, you know that you want to buy, but buy in this area. So you're probably going to wait for this range to surrender, and you're going to buy low. Back in the days, all right, so it's 2008 context, the signal shows up in here. Does that really look like a range to you? No, it is no range, so definitely that signal just meant absolutely nothing, all right? It wasn't bearishly oriented because it wasn't even a range, all right? So, I hope I answered most of your question. The last one is pretty quick and easy to answer. What are those triangles? So we're going to do it right away. Those triangles are simple price confirmation because the algorithm is going to detect when you are into resistant context where selling is possible upon signals only, and obviously if it fits a context, which means in here you don't even give a shit about all those red triangles. You're trending, you're bullish trending, so the selling signals is none of your concerns until you get to the divergent part of the trend. All right, so you need to be divergent, you need to have the pullback. Oh, do you see this? It's a pullback, isn't it? And then final excess. So only those three signals could have been traded, even though they were kind of trendy. They were late stage trending, which means in here is most likely profit taking signal rather than selling signals. And you always need to confirm this. So where you were trading is this signal in here. This one is the only one you would have traded. This one doesn't, but we'll talk about about momentum on the forthcoming video, because this is the first filter. The strategy has probably the highest level of risk limitation. So we're not only just limiting the risk with this tool, with this framework tool that does a pretty damn good job, like we've seen. I don't even see the prices, but I know what kind of prices matter, because all those indicators, all those indications have been designed for a specific purpose. If you figure out, if you understand how they work, which things does what, and in what context you're going to use this signal on this signal or this one, if you just figure this out, and it might sound a little bit complicated first, but it requires just a month to get it. Once you get it, you'll really be able to easily understand, without subjective analysis, what context you might be trading right now, what prices area matters, because you're always going to sell into the resistant context and buy into the support context, and never in between, never, ever, ever, ever. So you'll have price filtering, interesting price areas, but moreover, like we said, you're going to be able to put alerts on anything in there. I'm going to give you a quick example. Let's say, for example, you just highlighted this is a range, all right? You've given the first answer, it is a range, and it's immature because we're just first building the range boundary. What you're going to do is that you're going to alert out of Pro Framework, and you've got all those contexts in here: range alert, trend accumulation, trend breakout, trend divergence, trend final excess, trend pullback, trending range alerts. So out of this, once you answered what context you are, you're just going to say this. All right, we're ranging at the moment. Let's put a range alert. So the indicator will tell me when there is interesting prices in that context or any reliable information. As for example, if you set the range alert, it will alert you regarding the strategy rules. These are all explained very well and simple in the PDF. You're going to have a diagram suggesting and summing up all the core information you need to know and all the rules to figure out how to use this strategy. I'm going to do real simple in here. On a neutral range, the entry conditions are minimum 76% retracement. You need to overcome the resistant context, and you need to have a signal plus a triangle. So the signal is obviously momentum. We're going to talk about that later. And you need a triangle. So let's figure this out. In this range, 76% Fibonacci is in here. All right? The triangle is in here, and we need to be in context. So in here is definitely, this thing would have been triggering your alert. It would have set it a trigger, all right? So what we have in here is definitely a range tradable signal using the strategy. Simply by following the rules, you can use the alerts, and instead of waiting endlessly for something to show up and watching out candles that doesn't even matter, then you're going to be able to fully and simply identify the context, put in alerts, so you get the hell out of these charts, and you just wait for reliable trading informations to show up by triggering alerts. When the alert shows up, you put in the chart, you make your analysis, you review the informations, and you eventually take the trade. That's simple as that. That's how a semi-automated strategy works. And this is just the first step of risk limiting. We're not going to stop in here and move on to the second indicator that we're going to try to detail as well. I'm going to talk about pro momentum.